This is level 2 of the CFA program, the topic on corporate issuers, and the reading on analysis of dividends and share repurchases. We are nearing the end of a super important 3-reading sequence in which we began with capital budgeting, and we tried to determine how corporate executives maximize shareholder wealth. And inside of the capital budgeting decision, we had a great discussion on executives finding projects that have lots and lots of operating cash flow and ultimately positive and high net present values. Then we moved on to capital structure and the great reading given to us in 1958 by Modigliani and Miller. And we decided that corporate executives maximize shareholder wealth by, you ready for this? Investing in projects that have lots and lots of cash flows, ultimately high and positive net present values, plus they find an optimal capital structure, that optimal mix of debt and equity. Now in this reading, what we're going to do is we're going to ask ourselves the same question. How do executives maximize shareholder wealth? And the answer is going to be exactly the same. They find projects that have positive net present values. They arrive at an optimal capital structure. And now, are you ready for this? They maximize value by paying an optimal dividend and having an optimal number of shares outstanding. So these 3 readings are quite interrelated. And you might get that as you look through these learning outcome statements. Notice that we have 2 slides here. That this first one is almost entirely on dividends and dividend policy. That first LOS is probably the main one, with the remaining LOSs, maybe you could think of them as kind of sub-LOSs, but look at that first one. Regular cash dividends, extra dividends, liquidating, stock dividends, splits. Oh boy, and how do these corporate decisions impact shareholders' wealth? So that's an important one there. And then we'll go to the second slide of LOSs, and most of these are on repurchases, although there's a couple of dividend ones in here. So the focus of this reading is really on dividends and dividend policy and how it impacts shareholder wealth and ultimately stock prices and maybe even bond prices. And then we'll talk a little bit about share repurchases as well. All right, let's spend a few minutes attacking this first LOS. All right, so first part of this, regular cash dividends. Well, I'm guessing that you remember this from your early undergraduate days, and clearly you should remember this last year from level 1. I mean, let's go ahead and state the obvious. What do firms do? They find these projects that have lots and lots of cash flows, right? So what do they do with those cash flows? Well, they have a couple of choices. They can reinvest back into the company by finding more positive net present value projects. And of course, this is what all companies do. Companies can also compensate shareholders in the form of a cash dividend. So remember, from an accounting standpoint, that these product lines generate revenues and then expenses and then net income at the bottom right of the income statement. That income then gets switched over to the retained earnings portion of the balance sheet, and then dividends are paid out of retained earnings. And I'm guessing that you don't need me to tell you that there are lots and lots of companies that pay dividends. In fact, there's a host of U.S. companies that have paid dividends for over a century. And I bet if you had to guess some of these, you would say, oh, Coca-Cola, Procter & Gamble, Johnson Controls, of course, all those big companies have paid dividends for a really long time. Now, the idea for these large corporations is that they make this much in operating cash flow, and then they take a portion of it and compensate shareholders. All right, so forms of cash dividends. This helps us with that first LOS. So regular cash dividends, this is what we talked about here, right? Pays out a portion of profits on a consistent basis. I mean, most corporations pay dividends quarterly, but the board of directors could decide to pay dividends every day. I mean, that's probably not too efficient, but the board can do whatever it wants. There's an implication here that if a firm pays a stable dividend or a growing dividend over time, that of course it reflects the profitability. It reflects the ability of those assets to generate operating cash flows. what we've seen in lots and lots of academic and professional studies is that when dividends increase, and when those dividends increase, that tends to lead to increases in stock prices. And of course, there are irregular or extra or special dividends. What did I just say a moment ago? The board can do whatever it wants, right? So it could pay $1 dividend every 3 months. And then on February 17th, it could say, oh, we're going to have an irregular dividend of $27. And then on July 7th, it could say, hey, we're going to have a special dividend of 15 cents. Typically, these one-time cash payments are made under favorable circumstances. I bet you remember going back to the early 2000s when Microsoft had lots and lots of cash on its balance sheet, and shareholders and others in general who follow stock markets were suggesting that Microsoft pay a dividend. And in fact, it had this initial special dividend that amounted to, I can't remember the exact number, $30 billion or something. And then liquidating dividends, these are exactly what the name suggests, and they're not too terribly common. Now, second type of a dividend is a dividend that doesn't involve cash. Now, let's call this a stock dividend. So instead of receiving an actual payment of cash, shareholders receive extra shares. So the dividends are paid out in the form of new shares. What this, of course, does is it increases the number of outstanding shares, so stock price has to correspondingly fall. And so there's a good example, that green diamond point, a 10% stock dividend means that if I'm a shareholder and I own 10 shares, I'm going to get an 11th share. And so everybody gets that extra share, 10% stock dividend, which means that stock price probably has to fall by around 10%. In a stock dividend, shareholders' wealth probably remains unchanged. In fact, stock dividends are defined by the IRS as any distribution that is 20% or less. So a 10% stock dividend, of course, is less than 20%. And so what happens is that it's still a dividend. It's still considered a dividend, so it has to come out of retained earnings. But instead of having to subtract cash over on the balance sheet, think of like an accountant as a journal entry, it just comes out of retained earnings and goes into contributed capital. So total stockholders' equity doesn't change under a stock dividend, which means the balance sheet doesn't change under a stock dividend, but the accounts inside of equity are rearranged. Back when I was still doing research, I came across this term in an academic journal article that investors view stock dividends as cosmetic changes, which means they don't really impact operating cash flows, which means they really shouldn't affect stock price. Now, the IRS views any distribution of shares in excess of 25% as a stock split. By far, the most common stock splits are 3 for 2 and 2 for 1. And so I want you to think about this. In the old days, and excuse me, when I mean old days, I mean, like hundreds and thousands of years ago, if I owned 10 shares and the firm instituted a 2 for 1 stock split, I would have to actually take my 10 shares, turn them into the company. Now those shares had a par value, let's say $1, and then I would get 20 more shares, 2 for 1 stock split. And those new shares would actually have a less par value, 50 cents, right, versus the $1. And so what happens is that there is, just like a stock dividend, there's a dramatic increase in the number of outstanding shares. What did I say, 25% or greater? But what happens, of course, is that there's an increase in the outstanding shares, but then there's a corresponding decrease in the stock price, and then a corresponding decrease in earnings per share as well. Look at that last diamond point down there. It does not affect any shareholder's equity account. I mean, the only reality of life is that par value changes, and number of outstanding shares change as well. However, lots of corporations have outstanding shares that have no par value these days. So this is purely a cosmetic change. Now, those of you who are paying attention to math, you ought to scratch your head and say, wait a minute, Jim, you said stock dividends 20% or less, stock splits 25% or greater. What happens if there's a 23% increase? And for that one, I'm going to go ahead and say, I have no idea. I did lots and lots of research and I couldn't come up with any kind of answers. Maybe you guys have a good answer to that. But in my research, I never found a company that had a 21 to 24% distribution. How's that for almost totally worthless piece of information that I've given you? Reverse stock splits, these are not too common, but they do occur. And this is just the exact opposite of a reverse stock split. Think of a stock split as George Costanza in Seinfeld, and then the reverse stock split. Every decision George ever made was wrong, so he's going to do the opposite. So that's really what this is. What happens, we have a reduction in the number of outstanding shares, so this increases stock price. Look at that last diamond point down there. Common for companies in financial distress. So think about an executive who's seeing stock price go down and down and down and down. And that's an indication that that executive stinks, right? Stock prices are falling. So this executive does something drastic. Okay, well, I'm going to fake everybody out by having a reverse stock split, and that's going to increase my stock price. But of course, the markets are not fooled by that kind of stuff. We look at the last part of that LOS, a company's financial ratios. So how does all that stuff that we just talked about impact? Let's start with this illustration over on the right. I want you to think like an accountant here for just a second. So if we pay a cash dividend, what do we have to do? We have to take out cash, right? So this journal entry is going to be a credit to cash to reduce cash, which reduces total assets as well, right? Current assets and total assets. And then we're going to debit shareholders' equity, so we're going to decrease the right-hand bottom portion of the balance sheet as well. So what does that do to ratios? Let's look at that bottom line down there. So it's going to decrease the firm's liquidity ratios. That makes perfect sense. It's going to increase the debt-to-asset ratio. That should also make perfect sense, which means it's going to increase the debt-to-equity ratio. So just think leverage there. Now, what about stock dividends, stock splits, and reverse stock splits? They do not impact leverage or liquidity ratios because they don't change cash flows, they don't change the value of the assets, they don't change total equity. This is probably my favorite part of this article. Let's look at this LOS, compare theories of dividend policy. So once again, we're going to go back to our favorite economists, Modigliani and Miller. Now remember, of course you'll never be tested on stuff like this, but remember Modigliani and Miller's capital structure paper was published in 1958. They had a similar paper in 1961 on dividend policy. So think about this. You don't have to know anything about dividends here to answer the following question. If I said to you, all right, Modigliani and Miller had beautiful calculus and beautiful fundamentals in 1958 in showing us that capital structure was irrelevant in determining the market value of a company. And then in 1961, they wrote a paper on dividend policy. You would of course said, oh, well, their paper is going to say dividend policy does not have an impact on the market value of a company. And so look at the left-hand column there. Dividend policy does not matter, which means it will not have an impact on the value of the firm. Now, let me go ahead and editorialize here just quickly. The 58 paper was a thing of beauty. The 1961 paper was kind of a clunker. The math in there is not very, very attractive. I mean, it works, and in their Modigliani and Miller world, where there are things like, no taxes and no bankruptcy costs and all those kinds of noise, so to speak, that M&M prove once again that the value of the firm depends on, you ready for this? Let me remind you, the ability of the assets to generate lots and lots of cash flow. What did I call that in a previous recording? The quality of the assets, the quality of those product lines, and the weighted average cost of capital. Now, of course, when we relaxed those assumptions back in 1958, we found that companies can find an optimal capital structure. So we're going to do the same thing here. Now, it's not as linear as it was back in our 1958 and capital structure reading, but there's still some extra considerations that will probably impact stock price. This bird in hand argument, cash dividends are more certain than capital gains. And so what happens is that if you're a shareholder, you might say to the executive, all right, you have $100 in earnings. You can either pay that to me in a dividend, which means I get cash today, right? That's super certain. And I can spend or invest that $100 however I feel like. If, on the other hand, the executive takes that $100 and invests in a positive net present value project, that future is uncertain. I may never get that $100 back. So the bird in hand argument says that shareholders, they like dividends. They prefer dividends because they are less risky. There's also a tax argument, and this only occurs because A, the government views dividends as part of income, so there's a tax consequence to receiving a dividend, but it also arises because the government may look at dividends versus a buy low and sell high scenario in a different tax framework. So if the tax rate on capital gains is lower than the tax rate on dividends, then shareholders may prefer dividends or they may not prefer them. Some other critical issues that we'll talk about here going forward: a clientele effect, some signaling, and an agency cost, which is one of my favorite discussions. So let's go back to 1961, Modigliani and Miller. Dividend policy is irrelevant in a perfect capital market. It has no impact on stock price, the cost of capital, or the value of the firm. And the mathematics in 1961 is not nearly as exciting as it was in 1958, but it does work. And here's the idea. The idea is that if shareholders have a preference for income today, one of their choices is to pick up the phone and call the executives and say, hey, pay me a dividend. I need to go out and go on a vacation next week, and I need my capital today. So pay me a dividend. But what M&M pointed out is that there's nothing really interesting about executives and board of directors paying a dividend to me. I can just go sell some of my shares. This is called a homemade dividend. So look at the two circle points there. Selling shares to create a personal dividend if more income is desired, or I can use the dividend payments to purchase new shares. So, I mean, think about how crazy that is. The executives, they pay me a dividend, and then I go to the floor of the New York Stock Exchange and buy more shares if I don't want that. And so this homemade dividend policy, it works. And look at the purple bottom line there. Dividend policy does not affect the value of the company. So once again, let me just emphasize what I said in the previous recording, that M&M, they created this M&M world, this little fantasy world, not because they forgot about taxes or bankruptcy costs, but to focus our attention as good financial analysts on the variables that impact price, which is quality of the assets and the weighted average borrowing cost. But now, as we relax, as we strip away those layers of the fantasy world and we approach reality, well, then there are some things that matter, and there are some things that are going to impact stock price. So just like it's a goal of executives to find an optimal capital structure, it's a goal of executives to find an optimal dividend payment and an optimal repurchase amount. Now, the simplest next explanation for why dividends matter is this bird in hand argument that the dividend gets paid to me and I have this $100, as I just said a few moments ago, and so that's less risky. But this argument here doesn't really hold a lot of water for me because and others, because if I'm a shareholder, you seem to like risk, right? You don't invest in companies because you want to avoid risk. If you want to avoid risk, then go invest in treasury bills. So look at the bottom line, purple down there. Dividend policy affects the value of the firm because dividends are less risky than capital gains. That knowledge there alone probably gets you an accurate answer on the exam. The tax argument here, this is entirely relying on capital gains tax being lower than cash dividends tax rate. And so, of course, what shareholders do is they want to avoid getting dividends, because who wants to get a dividend payment and then have to pay, oh, let's pick a number, 50% on that dividend, when if the executives took that money and instead of paying a dividend, reinvested in positive net present value projects, which means that stock price will rise, then shareholders can go buy low and sell high and pay the lower capital gain tax. This is interesting from a long-term standpoint. You know, I entered graduate school back in the late 1980s, and this was a conversation back then. It's a conversation now. It's probably going to be a conversation well after I croak. So this tax argument probably is important. Now, remember back in 1958, Modigliani and Miller created this fictional fantasy M&M world in which investors had homogeneous information, which means that everybody had the same information set. And in addition, everybody processed that information set in the same way. This goes back to a rational investor. And so in 1961, M&M said, you know what? Dividends have no potential to signal private information because financial executives and boards of directors don't have private information because everybody has the same information set. But of course, in the 58 paper and the 61 paper, M&M present and offer the possibility that executives do have high quality private information. So signaling theory comes directly out of these M&M arguments. And there's tons and tons of academic research out there that show that dividends contain private information. They contain lots and lots of quality information. And so, you ready for this? If firms initiate a dividend, if they increase a dividend, this is a positive signal about the future prospects of the company. Of course, executives and boards are not going to increase the dividend unless they expect the cash flows to be sustainable, to be able to handle that higher dividend payment in the future. So when we as shareholders are watching our computer or watching television or looking on our phone and we see a company like Johnson Controls, who's increased its dividend every year for like 120 years, when they increase their dividend by 20%, what do? We run down to the floor of the New York Stock Exchange and say, hey, this has to be good news, because Johnson Controls is not going to increase its dividend unless this private information warrants that signal. And of course, the opposite holds true as well. When a firm decreases its dividend or omits its dividend, this is a signal of bad news. How about if I even say this? This is a signal of super bad news. And how about those of you who watched Barney when you were younger? This is super duper bad news. And this is what we know. We know that boards and executives go to great lengths to avoid a dividend drop or a dividend omission. So we know as shareholders that if it comes to that this is bad news. So stock prices will fall. How about this? Features of firms that grow their dividends over 100 years. Didn't I just say this earlier? So there's two of the firms I mentioned, Coca-Cola and Procter & Gamble. What are some characteristics? Well, without knowing anything about these companies or their industries, you would probably think that, oh, these are popular companies that have popular brand names. And of course, they're dominant in their industry. That's why we put brand names in parentheses there. So they have global operations. They probably have high profitability ratios. They have relatively low financial leverage. Now, that doesn't mean they don't use debt, because these companies, they all use debt. But their optimal debt levels is probably at a ratio that's much less. So that's why we have relatively low financial leverage. And then, of course, what do brand names mean? Brand names mean that there is probably stability in earnings, so there's less volatility in earnings. In fact, I say this to my undergraduate and graduate students all the time. I say, look, if you're a shareholder in Hershey Foods, do you want Milton Hershey to wake up every day and invest in Hershey Kisses or Hershey chocolate bars. And the students always say, they say, oh yeah, yes, yes. And I say, but those are brand names. So if Milton Hershey makes 100,000 Hershey chocolate bars today, he knows he's going to be able to sell them. So that's sustainable earnings over time. But that's why these companies then, and if you go to the Hershey webpage, you'll see all of their satellite product lines. They're trying to invest in riskier product lines. And of course, a risky endeavor for Hershey was these icebreakers 20 years or so ago, which interestingly enough has become a brand name in and of itself. Now, how about the clientele effect? Different groups of investors are attracted to companies with different dividend policies. Now, this generally means that we're going to probably rely a little bit on the tax implications that we talked about before. So there's some relationship between tax and the clientele effect. But what I also want to call your attention to is the simple fact that there are lots and lots of institutional investors out there that may or may not have a preference for dividend paying firms. In fact, some mutual funds have somewhere in their prospectus a sentence that says something like, hey, not only do we prefer dividend paying firms because of, here, let me do this for you, right? Dominant global operations, right? High profitability. So these are good companies to have in the mutual fund to begin with, but well, we like them because they pay the dividends. So the fact that mutual fund managers are interested in these stocks might mean that the stock price rises because, after all, I may prefer Coca-Cola's dividend, but if I go out and buy 100 shares, let's face it, I'm just regular old Jim. The academic research has a name for me. I'm an atomistic shareholder, right? Atom meaning I'm so small I can't even be seen. But a mutual fund that has, oh boy, hundreds of thousands or millions or tens of millions of shares, that mutual fund can become important. So clientele effect, which means that board of directors might make dividend policy decisions to cater to special clients. Now, I said this earlier. Here's one of my favorite kinds of financial theory discussions. All right, so you ready for this? Don't read the slide just yet. So here I am. I'm an executive, right? And I'm a popular executive. I'm an executive that has generated lots and lots of cash flows. I seem to have a knack for investing in positive net present value projects. So I have tons and tons of operating cash flow and lots of free cash flow. So what am I going to do with that free cash flow? Well, I have a couple of choices. If my compensation grows with the size of the company, I may go find negative net present value projects just to make the company bigger, right? I'm increasing the assets. In fact, this is particularly interesting because what I'm tempted to do is go take over other companies. And we know that when you take over another company, you have to pay a huge premium in this market for corporate control. So lots of takeovers have negative net present value. So I'm trying to grow the company in size and I'm enlarging, look at that second circle point, enlarging my span of control. Now, what else can I do with these free cash flows? I can say to myself, man, I have all this free cash flow because I'm a great executive. I deserve things like a bigger office, a limousine service to and from work. I deserve a country club membership. I deserve a helicopter. I deserve a Learjet. So I've got these explicit agency costs and then the residual losses. Remember, we talked about this in a previous recording. So here's this idea about agency cost. You ready for this? You guys are my shareholders and you know that I'm tempted. I'm tempted to do all this bad stuff for you, right? Helicopters and Learjets and take over companies that stink over there and pay a huge premium. So this is what you do. You come to the next annual meeting and you say to the board of directors, you say, look, and here's Kramer. I'm going to do Seinfeld again. Jim is out of control, right? So the board says, you know what? We like Jim. He's really a good executive, but we need to rein him in a little bit. So we're going to pay a huge dividend. So we pay the shareholders a huge dividend. So now my free cash flow is dwindling, and suppose it's dwindling to zero. So whenever I find, now remember, I'm a really good executive. Whenever I find these positive net present value projects, now I can't use my free cash flow. I have to go to the capital markets. So I have to issue shares of stock, and I have to issue bonds. So what's going to happen? I'm going to have the entire investment management community, institutional investors, some influential individual investors. I'm going to have lawyers and accountants and bankers. I'm going to have everybody coming in and scrutinizing me. And they're going to say, hey, Jim, what are you using that helicopter for? And I'm going to have to say, I don't know what I'm using it for. Something good. And so what that's going to do is that's going to reduce my temptation. Notice we have the word tempt in bold up there. So look at the third circle point. And I think it was worth it for me to go through that example. Agency costs can be reduced by increasing the payout of free cash flow as dividends or even interest over to bondholders. So bottom line, dividends may reduce agency costs. In fact, this comes out of a paper in the 1980s written by a dude named Frank Easterbrook. And I remember this article so well. Our professor, when I would have these seminar classes, he would assign us a journal article, and every journal article was loaded with calculus and all sorts of crazy math, and it would take us a whole week to figure out what was going on. He gave us this article, Frank Easterbrook, and there was no math in it, and we read it, and we were like, what are we supposed to do with this? We had no idea. But anyway, I like that bottom line. Dividends may reduce agency costs, thus increasing the value of the firm. All right, here's a super easy LOS. Explain factors. I probably don't even need to go over these, but just quickly, investment opportunities. Of course, what might happen if we're a company that has lots and lots of positive NPV projects available, we'll probably tend to pay out fewer dividends, right? We'd much rather invest in those projects. Companies with higher earnings volatility, less likely to increase dividends. All right, we talked about that before. This is also something that showed up, contractual and legal restrictions, back in our reading on capital structure. We may have some kind of a contract with the bondholders that say something like, hey, Mr. and Mrs. Board member, you're not allowed to pay dividends to the shareholders unless you do all these things. And so what do we have there in that second circle point? Maintain certain ratios. And there might be some restrictions on preferred stock as well. And then, of course, if we go to the capital markets and the investment banker looks at us and says, oh, sure, we'll help you raise $1 billion in equity or debt, and it'll cost you 22%. Tax considerations, we talked about that before, financial flexibility. Yeah, that makes perfect sense. So, if I'm writing an exam question, let me go back here. We have 3 of these slides. Factors that affect the dividend policy in practice. I'm going to go ahead and have a vignette with dividend policy implications and characteristics up here, and then somewhere I'm going to have somebody like a banker make a comment, and the comment will be something like, one of these 6 factors, and then you'll have to agree or disagree. Let me just pick this last one here. Companies looking for more flexibility are less likely to increase dividends as they want to preserve cash. So somebody might make that comment, and then your answer would be, oh yes, I agree with that completely. I did say earlier that taxes were important, so let's go ahead and calculate and interpret the effective tax rate under double taxation. So earnings are taxed at the corporate level, and then dividends are taxed at the shareholder level. Double taxation, I remember learning about this when I was probably in high school, but it didn't really have a meaning to me, I guess, in high school. But then when I got to college and I heard double taxation, I thought, that doesn't sound good. And then as I read Milton Friedman, and then as I read Thomas Sowell over the years, double taxation doesn't sound good at all as I have aged. Dividend imputation, earnings are taxed at the corporate level and at the shareholder level, but there's some kind of a tax credit in there. This is that franking credit. And then the split rate system is 2 different tax rates. So let's go ahead and work through quick examples here, because the LOS does say calculate and interpret. So here's a simple example. We've got earnings before tax of $300. All of that gets paid out as dividends. tax rate 30%, marginal tax rate of 15%. And then under a split rate system, there is that secondary tax at 20%. So the question is calculate and interpret the effective tax rate. Okay, on those three. So here are the answers. And I'm guessing that all we're going to do is use those equations on that previous slide. Effective tax rate on dividends. So we start with the corporate tax rate of 30, and then we go ahead and add something else to it, right? We've got 1 minus the corporate tax rate times the 15% marginal. So that gets us up to 40.5% as the effective tax rate on dividends under double taxation. So don't think that it's just 30 plus 15, right? Because I mean, in a multiple choice question that one of your choices is going to be 30%, one of your choices is going to be 45%, and one of your choices is going to be 41%, rounding. The CFA Institute does say, closest to. All right, dividend imputation. This is kind of a plus and a minus. So you add the 30 and you subtract the 30. So the effective tax rate is just the 15% marginal tax rate. And then under the split rate system, we do some similar calculations as we did above, but that secondary corporate tax rate is now 20%. So you get 32%. All right, so let's go and switch over to board of directors. How do board of directors process all of this information that we've talked about on these previous slides? After all, it's the board that has to decide what is what did I say earlier? 1958, Modigliani and Miller led us to an optimal capital structure decision. Then 1961, they're now leading us to an optimal dividend policy decision, which of course rests on the board of directors. All right, so stable dividend policy, this is most common. And here I can do this with just a quick showing. So what do we know about earnings? Earnings goes like this, right? And if dividends goes like this, then shareholders are going to say, what in the world is going on? So boards say something like, okay, if earnings go like this, we want to go like this, right? So dividends are based on, long-term forecasts of sustainable earnings. Boy, how many times have we talked about sustainable earnings? And so think about these companies that increase their dividends by 5 or 10% every year. And now remember what we said, these large companies like Coca-Cola, and Colgate-Palmolive, they have brand names. So their earnings, they might be 100 and then 107 and then 111 and then 116, so they might pay out, let's say 10% of that or whatever it is. But it's not based on those different changes. That's a long-term slope. So what happens if in that fourth or fifth year earnings goes from, 120 to 300? Well, there's no way that you can expect Colgate-Palmolive to continue to, a doubling or a tripling of earnings. So it's a long-term forecast on sustainable earnings. And that target payout ratio is based on long-term sustainable earnings. All right, so the increase in dividend is going to be a function of earnings, right? So increase in earnings times a target payout ratio, and then an adjustment factor, which is shown right there in gray in the bottom. Now, constant dividend payout is a constant percentage of net income. So take dividends over earnings and have that be the dividend payout ratio. And this goes back to, do you want earnings to go like this? And do you want dividends to go like this? So this is not too common. And then residual dividend payout it's way more common than constant dividends, but it's not too terribly common because it's more volatile than the stable policy that we talked about on the previous slide. But what these dividends are, and I kind of like this as an idea, if you just think about it on its surface, all right, so you have this earnings. Let's suppose it's 100, and so you have a choice. You can reinvest those into positive NPV projects, and if If there's $100 in positive NPV projects out there, well, then the shareholders don't get any dividends. But if there's only 10 in positive NPV projects, because remember, we learned about this in our economics readings, the economy expands and the economy contracts. So when the economy is contracting, there are no positive NPV projects out there, but those existing product lines are probably generating cash flows. So you're not going to pay all those out as a dividend. And there's a good residual earnings equation. Let's go ahead and take a look at an example. Compare the stable dividend, constant dividend, residual, and calculate. So here we're doing the second part of the LOS, calculate. So we're given some net income and capital expenditures, so we can just assume that those capital expenditures are investments in positive net present value projects. So notice from right to left, our net income increases from 25 to 35 to 47, and then we invest 5, 7, and 12,000. So here's our stable dividend policy, target payout of 40%, adjustment factor of 0.25. And so this is what we're going to do. We're going to take that increase in earnings, right? So let's just look at the 2020 column. So 35 to 47, so that's 12. Target payout ratio of 40, the adjustment factor of 25 is given. And so if you do all that math, you get a dividend of 1,200. You do similar math in 2019 and you get 1,000. So those dividends go up by, what is that? That's 20% under a stable dividend policy. Under a constant dividend policy, however, we're going to take our earnings, what were they back there? 35 and 47, right? Multiply those by a constant dividend payout of 5%. Notice that's in bold up in that top paragraph. And so those dividends go from 1750 all the way up to 2350. And so that's a much bigger increase than what do we have back here? That was 20%. So there's a much bigger increase. What is that? About 35% or so. How about a residual dividend policy? All we're going to do is take our net income. So that's the 35 and the 47, and we'll subtract. Here, let me just go back quickly. There's the 7 and the 12 of investment in positive NPV projects. So that gets us 28 in 2019 and then 35 in 2020. So that's an increase of, I don't know, what is that? An increase of about 25% or 27%, somewhere in there. All right, let's switch over to these share repurchase methods. And let me just remind you, so what are we doing here? We're the executives. We've generated lots and lots of cash flow. We have two choices. We can reinvest in positive NPV projects, or we can distribute those earnings to shareholders. And we talked about the first way, of course, that's a dividend, but the second way is through a share repurchase. Now, the big difference here is that when we pay a dividend, all shareholders have to receive the dividend. They have to accept it. I mean, a shareholder can't say, oh, I got this dividend check in the mail for $100. I don't want it. Let me rip it up. The IRS is just going to assume that you received and cashed that check. On the other hand, share repurchases, what the executives are doing is they're repurchasing a fraction of the outstanding shares. So only those shareholders who want to participate in the share repurchase will be able to generate income. Now, by far, the most common way, the most common way that executives and boards repurchase shares is to do this just like you and I do. What do? We show up on the floor of the New York Stock Exchange, we reach into our pocket, we take out $100 and we buy one share of stock, right? And then we go home and we move on with our lives. Well, executives do the same thing. So this first way is called an open market repurchase. And so they just repurchase them in the open market. Now, of course, if I'm a company like Coca-Cola, I'm not repurchasing one share or 100 shares. I'm going to repurchase tens of millions of shares to make this a material event, right? So I can't just show up with a wheelbarrow full of money on the floor of the New York Stock Exchange, because the specialist is going to look out at me and knows that I'm in the line to buy shares, well, that specialist is going to say, hey, I know Jim. I know he works for Coca-Cola. And look at, he's got $1 billion in cash out there. Oh, I'm going to raise the price really high before he gets here. So we've got to do this kind of secretly. That's why when executives announce an open market repurchase, they say something like, hey, we're going to repurchase, 500,000 shares or 500 million shares, and we're going to do it from time to time in the open market over the next 3 years or 5 years, et cetera, et cetera. So they kind of do this as clandestinely, is that a word, as possible. Look at the last circle point there. Most flexible as the company can choose the timing of the transaction. So this is really the cool part, right? That the executives who we know have private information. So what are they going to do? They're going to go in and buy the shares when they perceive them to be undervalued. And they're going to avoid buying the shares when they perceive them to be overvalued. Now, what did I say? That these open market repurchases, they're by far the most common. And they take a long time, right? This is a long-term event. But there are short-term events that can occur. One of which is called a Dutch auction repurchase. And this occurs in the relatively short time period. If I'm an executive, I may say something like, all right, I'm going to repurchase 100 million shares. And if my stock price is trading at $100 today, I'm going to repurchase those, 100 million shares over the next month. So you have 30 days to decide. And oh, by the way, you get to pick the price, Mr. and Mrs. Shareholder. I'm going to accept bids in the following range. So what did I say earlier? Stock price was 100. I might say I'll accept any bid from $108 to $120. So you as a shareholder, you have to decide whether or not you want to sell the shares back to me. And then you have to decide which price in this Dutch auction. Now, this is the way a Dutch auction works. And it's super cool. Is that you might think that the shareholders would say, well, we want to get the highest price. So everybody, all shareholders are going to say, hey, Jim, repurchase these shares at $120. And that sounds like a really good strategy. However, are you ready for this? One of you out there is going to be really smart and you're going to say, you know what? I know what Jim's going to do. He's going to start accepting bids at the lowest price and buy all those shares back at the lowest price before he gets to 120. That's the highest price. So you, Mr. or Mrs. Super Smart Shareholder, are going to say, I'm going to bid $119.99. So my share is going to be the first one that Jim buys, and then he's probably going to have to prorate all of those shares at $120. And then you're probably not the smartest person out there. You're just among other smart people. So someone's going to look at you and say, oh, Mr. or Mrs. Smart Shareholder, I know you're devious and I know you're going to try to get your shares repurchased at $119.99. So I'm going to bid $119.98. And then the bidding goes lower and lower and lower. And all of a sudden people start thinking, wait a minute, I want in on this repurchase. So I'm going to bid $108. Oh my gosh. So this is what happens. Jim, what I do is I take all the bids ranging from 108 to 120, and I start buying at 108, 109, 110, 111, but I don't pay 108, 109, 100. Whichever gets me up to the 100 million shares, let's say it's 115, everybody gets that $115. So think about it. What started out as you guys as shareholders trying to bid 120 to get the most out of me ends up, because of human nature and behavioral economics, ends up meaning that I can actually buy the shares back at 115. So you could bid at 108 and you might get 108, but you might get 115, you might get 120. And so what it does for me is it allows me to purchase a bunch of shares so that, oh my gosh, are you ready for this? I'm going to increase leverage and I'm going to move to my optimal capital structure in the short term. Here's the link between this reading and the Modigliani and Miller capital structure reading. So notice the bottom, the highest price is then applied. What it allows me to do is it allows me to buy a ton of shares at the lowest possible price. And I get you guys to pick Dutch auctions are super cool. They're not really all that common, but they occur a couple of times a year. What is about a little bit more common is this fixed price self-tender offer, this third one. So what did I say earlier with the Dutch auction? I'm just going to buy 100 million shares and I was going to accept prices between 108 and 120. Well, a fixed price self-tender offer is exactly what it says. If my price is $100, what I'm going to do is I'm going to offer, let's say, $120 a share. So you have to decide as a shareholder, do you want to participate and do you want $120? Now here, this is not testable, but I'll give you some idea of how cool these two things are. I've actually done some research on Dutch auctions. The average repurchase premium in the Dutch auction market is about 14%. The average repurchase premium in the fixed price self-tender offer market is about 20%. So Dutch auctions work and they are super, super cool. And then the final repurchase method, this usually occurs when there's a negotiation going on for a merger. And so we negotiate with a major shareholder, whatever. So we'll probably talk to some institutional investor and says something like, hey, you know what, instead of you going through a proxy contest or taking over our shares, how about if I just pay you, if stock price is 100, how about if I just pay you $130 a share or some other number? All right, here's a good LOS because we're asked to calculate and compare. All right, so what are we worried about here? When we repurchase our shares, and let me go back quickly, in any one of these manners, what are we doing? Well, we're paying cash, right? So cash is going down and we're repurchasing our outstanding shares. So the equity is shrinking as well. All right, so these repurchases, assets are going down, equity is going down, but wait a minute. Nothing is happening to the top right of the balance sheet. Nothing's happening to the bonds. So the bonds are becoming larger in relation to the equity. And then something might be happening to net income. All right, so what we need to do is we need to figure out what the impact on EPS is going to be. So there's our regular old equation for earnings per share. We know that all the way back from kindergarten, right? And so here's the general idea. If net income is constant over time, and that's a pretty big restrictive assumption here, but a smaller number of shares after the buyback leads to higher earnings per share. Now, of course, the question then becomes, how do we pay for this repurchase? If we use cash, that's one thing. If we use a bond issue, that's another thing. And so, if we're financed with borrowing funds, both the net income and outstanding shares will be decreased. But we need to see exactly what that relative decrease is to determine whether EPS will go up or go down. So let's take a look at two scenarios here. There's number one and there's number two. So internal financing. Post-repurchase EPS will be higher than the pre-repurchase EPS if the rate of return on retained earnings is less than the cost of capital. That should make perfect sense based on everything that we've discussed so far. But here's the more interesting one. What happens if we use borrowed funds? So here's a really good relationship to memorize. So earnings per share will increase when the after-tax cost of debt is less than the earnings yield on the shares before the repurchase. And then the opposite will happen if the after-tax cost of debt exceeds the earnings yield. And then, of course, if there's an equal sign in there, it remains unchanged. So let's go ahead and work through some examples. So here's part one of the LOS, repurchase financed by the company's surplus cash. So here we have a company and we're given a handful of relevant information, 12 million outstanding shares, net income of 150 million, stock price of 40, cash not needed for operations, 200 million. Let's see. Estimate that shares could be bought in the open market at $50. Calculate the impact if ABC buys back these shares. All right, so let's look at current earnings per share. There's our regular simple formula there, 150 over 12, that gives us $12.50. After the repurchase at $50 a share, Number of outstanding shares reduces by 4 million, right? So that leaves us with just 8 million outstanding shares. So our EPS is now 1875, which means our EPS has increased by 50%, right? 1250 up to 1875. That's exactly 50%. Moving on to the second part of the LOS, what happens if we use debt? So let's look at a different company here. 3 million outstanding shares, net income of 9 million. We're going to repurchase 300,000 of those shares at a price of $50 a share again. All right, so you ready for the question? Calculate, just like we did before, how about if we have to pay our bondholders or whoever's lending us money an after-tax interest rate of 4%? So we'll work through the same math as we did on the previous slide. Current EPS, 9/3, so there's $3. The total cost of the repurchase, there's $50 times the 300,000 shares, so that gets us up to 15 million. And that's going to cost us 600,000 in the after-tax cost of funds. So our earnings per share after the repurchase now turns out to be $3.11. Notice that we went from $3 up to $3.11, and that's because our after-tax cost of debt was 4%, but our earnings yield, there's the 3 over the 50, is now 6%. So the fact that 6 is greater than 4 means that the EPS had to increase. What did we say? Let me just go back here quickly. So EPS will increase when the after-tax cost of debt, which was 4%, is less than the earnings yield, which was 6%. So if I'm writing this exam question in a vignette, I'm probably gonna ask this question here in a qualitative framework. But here, I'm going to ask this in a quantitative framework so that you'll probably have to calculate that 311. That sounds like a good equation. And that's a simple calculation. How about the impact of share repurchases on book value per share? And there's a good summary table at the top. If the market price per share is greater than the book value per share, then after the repurchase, then the book value will decrease and just the opposite will happen. And we'll see this here as an example. So let's suppose we're considering a repurchase of 6 million worth of shares, market price of $30, outstanding shares 12 million, book value of equity of what did I say there? 400 million. So let's go ahead and just do some quick math here. So book value per share before the buyback, that's just the 400 divided by 12, right? So that's around 33. Number of shares repurchased turns out to be 200,000. And then that leaves us with 11,800,000 shares remaining. And then our book value per share afterwards. Don't forget to take out the 6 million in the cost. So that gets us 33.39. So we had about 33 before and we have about 33 after, but there's a 6 cents increase. Explain the choice between paying cash dividends and repurchasing shares. All right, so this LOS is pretty much a summary of what we've been talking about. All right, so repurchasing stock compared to cash dividend, potential tax advantages. Of course, that's super important, especially if the capital gains tax is, let's say, 5% and the tax on dividends is 45%. So there's a huge potential tax advantage. If the difference between those tax rates narrow, then that advantage, of course, goes away. And at some point, those rates don't even have to be the same. They have to be near each other, where shareholders will say something like, you know what, they're essentially the same because, when I go to the New York Stock Exchange and sell my shares, I'm faced with, bid-ask spreads and information asymmetry costs, and I have to drive to the New York Stock Exchange. That costs me money, et cetera, et cetera. Signaling, this is super important here. Positive and negative signals. So, of course, when the executives believe their firms are undervalued, they're going to repurchase them. Now, remember what I said. The open market repurchase, the board and the executives, they can get in and get out of the market, when the value goes like this compared to the intrinsic value over time. But for a share repurchase, whenever we find those executives buying those shares of stock, we know that's a positive signal. But I want you to think about this, especially for a Dutch auction repurchase and a fixed price self-tender offer. This is a clear signal because the executives are using lots and lots of cash over a short time period to signal their private information. And by the way, not only is a share repurchase a signal of positive future prospects of the company, it's probably also a signal of a move to an optimal capital structure. Now, what did I say earlier? That those open market repurchases are way far the most common. So that's this managerial flexibility over there. Share repurchases allow executives to choose. They can say, you know what, we're going to repurchase all of these shares over the next 5 years, but we don't have to do it. We're not obligated. There's not a legal and binding contract. So even though the promise might be to pay over 3 or 5 years, all the board has to do is say, hey, you know what, we told you that we were going to buy 500 million shares over the next 3 years. Well, we've bought 120 million over the last 6 months and we're done. Or they can buy it for 5 years and say, hey, we're going to continue this in the future. So that's the idea of managerial flexibility. How about this one here? We know that these large companies, they award their top executives and even middle executives with executive stock options. And so every time that executive says something like, hey, I'm going to exercise my option, so I'm going to buy shares at 50 from the company, right? So I'm going to get these shares, the executive is going to get these shares and then go and sell them on the floor of the New York Stock Exchange for $70 or $80 or $100. There are now more outstanding shares. So sometimes the board and the executives say, all right, we have this potential dilution out there because all of our executives are exercising their options and selling their shares over on the floor of the New York Stock Exchange. We want to shrink those number of outstanding shares back to some kind of, reasonable or rational level. And then, boy, look at the, what is that? Saturn, Jupiter, Mars. Who is that with the rings over there? Didn't Matt Damon go to that planet there? Oh, no, that was Mars. Anyway, so look at this. What we're saying, and I've said this before, that what we're doing is we're trying to move to an optimal capital structure. So repurchasing shares can do this. All right, how about that last question on this slide? Why do companies prefer repurchasing stock over paying a cash dividend? So share repurchases increase when the economy is strong. This should make perfect sense. What do firms do? Firms that pay a dividend are generally, even though they're not legally obligated to pay the dividend, they tend to pay the dividend over time and they pay it based on sustainable earnings. But these repurchases are kind of, they're bigger events and they tend to do it when the economy is strong. How about global trends in payout policy? This is not going to be surprising to you at all. Large profitable companies have consistent payout policies. Smaller or less profitable companies, they either pay a small dividend like a penny or they don't pay any dividends at all. This is interesting. The number of companies paying cash dividends has decreased and the number of companies participating in share repurchases has increased. This probably has a lot to do with the differences in tax codes and tax rates. There's lots of statistics that I could cite you from academic research that I have read over the years, but I'm not sure it would add a whole lot of value to your ability to answer questions on the exam. So remember those two trends there. Dividends have generally fallen, share repurchases have generally increased. And this, by the way, has caught the attention of politicians. You may have noticed politicians saying, oh, companies are repurchasing their shares instead of doing other things. So it's a political issue as well. Let's get back to this concept of free cash flow and dividends and whether or not we have some ratios that warrant a dividend payment. So there's the dividend payout ratio. We know that from a long, long time ago, right? Dividends over net income. If I take the reciprocal of that, I call that a dividend coverage ratio. And so look at the dividend coverage ratio. So I have net income, let's say it's 100, and I have dividends, let's say it's 20. So what does that mean? That my net income is 5 times as great as the dividend that I'm paying to my shareholders. Now, how about a free cash flow to equity coverage ratio? I love free cash flow. Remember, operating cash flow is defined as the cash remaining after all expenses have been paid, including depreciation. Free cash flow is defined in general as operating cash flow. So let me repeat that. It's the amount of cash remaining after all expenses have been paid, including depreciation, and all investments in positive net present value projects have been made. And so, free cash flow to equity has a pretty specific definition, but look at this here. What we're doing is we're saying, okay, free cash flow to equity, which is, here, let me just go back here real quickly, which could be super, super different than net income in the numerator, right? Free cash flow, probably nowhere near net income. And then we're going to divide that by dividends plus share repurchases. That gives us our free cash flow to equity coverage ratio. And by the way, there's a good old formula down at the bottom for free cash flow to equity. And so what we're doing here is if that free cash flow to equity exceeds 1, then what we're doing is that we're generating lots and lots of operating cash to fund our dividends and share repurchases, which helps our liquidity. Free cash flow to equity equals 1, so all available cash is returned to shareholders, which, by the way, is a way different interpretation of a dividend coverage ratio of 1. Free cash flow to equity less than 1, so this hurts liquidity. Of course, this is not sustainable. I teach my students all the time that it's okay for free cash flow to be negative. If in fact we're investing in lots and lots of positive net present value projects for a short time period, it's not okay if operating cash flow is negative, but it's okay if free cash flow is negative for a short time period. All right, so let's take a look at just a super quick example here. Dividend coverage ratio, there's 50/2, so that's 25 times. Free cash flow to equity coverage ratio, 25/5, so that's 5 times. Notice that the free cash flow to equity ratio exceeds 1, so this is an improving liquidity position. The last part of this reading is a couple of paragraphs on dividend safety. Safety relates to the company's ability to continue paying the dividend or maintaining a growth pattern. So this goes all the way back to what we learned, back with the Myron Gordon growth model and sustainable growth, that growth rate in the denominator of that equation. So we can use the ratios from our previous slide to give us a sense of dividend safety. So look at that blue diamond point in the middle. Higher coverage ratios and lower payout ratios imply safe dividends. This safety means like if we're a shareholder, like a huge shareholder, like an institutional investor who tells our investors that, hey, we're investing in large firms that have brand names that have stable dividend policies. Well, one way we can make that determination is by looking at these ratios and making a comment on the safety of those dividends. Characteristics of companies unable to sustain their dividends. This is not surprising to you at all. Small, young companies, highly volatile industries, those industries that spend lots of money on research and development, companies with profitable investment opportunities, lower return on assets, high debt ratios. Those high debt ratios, they probably include some kind of a bond covenant in there. And then, of course, under financial and operating distress. And that takes us through all of these learning outcome statements. And so if I'm writing a vignette, I'm going to combine all 3 of these: capital budgeting, capital structure, and dividend policy. This is a great cumulative question. So focus on Modigliani and Miller and about what Modigliani and Miller taught us about the value of a company. And that leads you to lots and lots of good answers throughout these 3 readings.